Hello guys, welcome back to another Lumley training video. In this one we're going to be doing some in-depth stock analysis on BlackBerry, ticker BB. So obviously down on the day, basically at 7% down the day, big moves to the downside, markets have just closed as well. What are we looking at going forward? So it does actually look like if BlackBerry can continue up, there can be what I would consider quite easy trading opportunities. Now how would we find these? So if we continue to push up, we're looking really at the first deviations on both the 6 month on the left and the 1 year on the right, because coming into 552 and 567, these are our first deviations. The first time you hit this level at a minimum, you expect a pullback. And so the way I tend to play these is, for example, I'll enter at 550, I'll have my stop above the range, so say probably even 75 cents or so. And the reason I'm having quite a wide stop on that is because we're looking for two entries, one at 550, and if we do continue up around 570 as a second entry, or kind of to enter full size. So we'll have a look to have a stop probably around 580. Our average will be around 560. So, you know, risking 20 cents on that play. Now, how would we be looking to play that? So obviously if we're risking 20 cents, we're looking at a stop around 3 to 4%. Now, how are we looking to make profit on this? So really our kind of first key target would be looking into $5. If we come into $5, that's 10% upside, and where we'd be looking to move our stop to break even, locking in some profits. Now we would be holding some size, and I'd be looking to hold it down to around 475, so that would be around 15% upside. Reason for holding for that far is because that is our statistical mean on the 6 month, our closest of the two statistical means, and this is where we expect price to reverse to. So that's how the trade plan I'm looking at going forward. And the reason I love trading this kind of way is obviously we're risking, say, even 4% on the high end. The risk reward is just always there. Obviously we're risking on the low end for a 10% upside, but if it continues in our direction, we're still looking for 15% upside on that kind of trade. So that's the first kind of trade idea going forward. Now if we retest this level and we break through, what I'm then looking for is a break, a retest, and if we hold this level as a support, then I'm looking at a 635 target in a direction, then looking at 725 and $7. As these levels are so close, use them as a zone, a bit like when we talked about this 550 and 570, we use them as a zone because they're so close. Trying to play them as individual levels can just be quite difficult. The only way we play them individually is by how we do our size. So obviously when we hit these levels, I'm looking to hit short. I'll hit in short 50% size there, and another 50% of my size at 570. That will make a normal position. That's probably going to be that same size that I would just use off the get-go from 630, for example. So that's just how I use those ranges if they're quite close. Now if we break that and continue up, we have a final level at coming into 806, 845, and a final one at 985. So these are our resistances going forward, and really what I'd be looking to play, and the reason I'd be playing the upside more than the downside is obviously the stock was a big mover before, was a big hype stock before. So if it pushes up to this level, all you're going to see happen, and why we expect to play the reversal, is all it's going to be is people who are bag holding kind of taking profits. And it might even be institutions, especially kind of hedge funds, hitting the shorts when they come into these overbought levels because they're fundamentally overvalued, or very much overvalued at these kind of levels. So it makes sense to be getting short. So that's why I'd be looking for that trade ideas. If it does start pushing to the downside, obviously we do have statistical means at 460 and 430. These are levels I won't trade off, but trade to, and the reason for that is they're mean, they're considered fair value buying at that level. You're not really coming into any sort of bias. It's not overbought, it's not oversold, you're just buying at fair value. Obviously if you're investing, that's perfectly fine, but as a trader we want some reason to be entering, and to me there isn't one at that level. But obviously if I was short, this would be a target, and if I was long below that level, that would have been a target as well. Now if we continue lower, then we do have supports at 383, $3 to around 290, and then if we broke that, we have final levels going down to 210, 150, and that's and 125 is all we'd be paying attention to. Like I said, I wouldn't really be focused on these downside levels because I think there's just a lot of risk on the table to take it to the downside, for the main reason being, again, it's a fundamentally weak company. So taking it at these levels, you're more relying on the hype coming back, or for some reason some sort of squeeze to come. If we're trading the upside, trading the direction of the short, obviously it makes sense more from a fundamental standpoint. and if it lines up with the technicals, can just make that trade even better. And obviously the technicals will help you get the good entry, even if the fundamental reason is overall there. Anyway, I hope you enjoyed the breakdown on BlackBerry. If you did, why not drop a like and subscribe and check out one of these 2 analysis videos.